As is common with these kind of events, let's start with some basic housekeeping comments to make this evening an informative success for you and all of us. I assume that there will be some questions based on the content, so there is time for the Q&A at the end. For this, kindly fill in your questions during the webinar in the communication channel below, and I will combine and address them where possible in the closing part of the webinar. Please do note that this webinar is being recorded and might be used for public distribution and/or other events and clients. The presentation and its charts are available for personal use, so if you want a copy, just reach out to me or your relationship manager at Leong or CME. I will also post them later on my corporate website. Copies of the whole webinar will be available for replay online, and if you want to stay in contact afterwards or have more specific questions that are not answered yet or are not suitable for the whole audience, feel free to reach out to me via LinkedIn or visit my corporate website for contact details, www.pretb.net. As we have planned for around 1 hour only, let's now quickly move to the content part. First, let me start with a brief introduction on who I am. As mentioned, my name is Paul Bloemendaal and I'm currently CEO for both PRETB Private Limited as well as Paper Trader Private Limited in Singapore. I've been active in the agricultural commodity trade since 2004 with a range of increasingly senior roles in companies like Cargill, Noble Group, now Cofco Agri, Citibank, Ruchi Soya, and since 2016 with my own boutique advisory firm named PRETB Private Limited. I've been active as a trader, risk manager, group commercial head, consultant, entrepreneur and investor, but always with a focus on the opportunities in the agricultural commodity space and industry. My main corporate leadership experience was from 2004 till 2016 when I was managing edible oil trading and shipping desks around the world, always making sure our investment and trading decisions were based on fundamentals with limited speculation and proper risk management. That will also be the guideline for today's webinar. My latest and current venture is Paper Trader, reshaping the face of markets, a new technology firm that will improve the transparency and auditability in our markets for physical commodities. This is thus not for the futures and options part that we are discussing today, but with a high correlation and synergy. For more information, I welcome you to visit www.papertrader.com. For those of you that are interested in staying informed on a regular basis, besides my consultancy, advisory and investment business, I have been writing a weekly report for the CME Group since 2016, in both English and Chinese, every Sunday ahead of the Open. That gives my personal market view and trade IDs suitable for the next week or month. Feel free to register for it online to get it delivered directly to your inbox via the links on the CME website that are also available in the presentation deck, www.cmegroup.com/market/agriculture.html. As a result of the partnership with CME, it is also widely distributed via other channels, like WeChat, if that's easier for you to use in your active trading session. I publish it personally on the PRETB Private Limited LinkedIn profile and the website www.pretb.net. Now, let's move to the actual seminar and see what we will be discussing today, as that is why you registered and called in to begin with. Today we will talk about the following. I will start with an introduction to the edible oils markets around the world and with a closer look at the CME BMD ones, as those will be most likely fitting with your core interest. During the whole evening, I will touch base on risk management in general, or better said, the why use futures and options or OTC structures to manage your exposure. This is likely more suitable for the participants who have physical exposure to the edible oil segment, like plantation owners, the refinery managers, the shippers and the consumers of the products. I will spend quite some time to take you through the state of the current market scenarios based on the latest supply and demand numbers. Fortunately for us, we are now at the end of the month and a bit at the end of the season. So we have a lot of data points that came out from the USDA, MPOB, CME, S&P Global and others that we can discuss today. Talking about the CME Group, they are the most liquid market, but not per se on your focus yet. It is worth to understand them better. Likely, due to being here in the region, Bursa gets a larger part of your flow at the moment, but there are more opportunities around that could benefit you as a trader. I will show their, CME, performance for the last few months in terms of volatility and volumes. During the whole call, we will discuss medium and long-term price drivers, macro, fundamental, seasonal, political and others, but feel free to add your comments, IDs, feedback and questions in the chat on this platform as well. To present trade IDs is always expected and suitable in my view, in an event like tonight, but that comes with a caveat for compliance reasons. Please do note that these trade IDs are of course only provided solely for informational purpose and should not be regarded as a recommendation to buy, sell, or otherwise deal in any particular investment. Please be aware that, where any views have been expressed in this seminar, I may have had many varied views over the last 12 months, including contrary views. Any evaluations of underlying assumptions made are solely based on my personal market knowledge and experience. Furthermore, the information in this seminar has not been prepared in accordance with legal requirements designed to promote the independence of investment research. The given material is subject to change, and although based upon information that I consider reliable, it is not guaranteed as to accuracy and completeness. As all information is from public sources, and unless otherwise indicated, it came from the USDA, but where possible I will show where it came from, or if it came from my own files. But if I forget this at any point, just reach out to me and I will let you know what the origin was. We will end the evening with around 10 to 15 minutes of a question and answer session that hopefully adds a lot of flavor and even some more ideas. How to capture the opportunities to invest in the commodities bull market 2021 with a focus on edible oils is our topic of the evening. So to get to this, we have to focus on the basics first and then see where that takes us for future valuations and investments. I assumed that most of you are retail investors that will have some experience with trading the Bourse Malaysia futures or perhaps the CME index futures. But not all will have had previous exposure to the CME Agricultural Commodities Toolkit that can create significant additional and complementary opportunities. For those of you that are also in the edible oil industry, some information will look basic or familiar, but please hang in there for the sake of the others, and please do add value by posting your questions online at all times. As you called into this seminar tonight, it means that you are likely already active or at least interested in investing, trading and hedging with listed edible oils and could potentially look to expand your scope in terms of types of products and markets. For most of us, our current exposure will be either here in Malaysia and Singapore with the Bourse Malaysia palm oil futures or already with some of the CME Group's other products. Perhaps you even trade the Dalian commodity futures or some of the Indian exchanges like MCX or NCDX. The most recent one that was launched in Singapore was the fairly active Asia Pacific Commodity Exchange, APEX, that has now also listed crude palm oil and palmoline futures and shows some decent daily traded and open interest volumes. But most of this is from market makers and not yet from real market participants as far as I know. As a trader investor, I would refrain from it, as in my view, we should always aim for the market where there is the best liquidity and where there is a connection with the underlying commodity product to really have proper price discovery in case of markets making unexpected moves. Remember the crude oil futures in May hitting negative numbers in the US? That showed that you want to actually trade something real and deliverable, and not just a financial product that could have been anything. Other markets, like the sunflower quotes presented by companies like S&P Global, are more for reference prices and not suitable for retail investors to participate in due to liquidity and transparency issues. To me as an investor, as a result of the previous comments, I thus for the moment focus on only two markets, as they are accessible for anyone around the world and liquid enough to be price drivers for the physical underlyings. First, the CME Group with its CME soybean oil futures, CME palm oil futures in US dollars, the rest of the palm oil suite, and the various spreads that can be trading accordingly, POGO, BOGO, POBO and oil share. Secondly, the Bursa Malaysia crude palm oil futures, who are still the world's benchmark and thus the best ones to invest in, either outright or in spreads with the other markets. As a commodity trader, I had access to the Dalian futures out of my physical assets, but as most of us on the line today will not have that yet, do note that from the end of December onwards, the DCE palmoline futures are expected to be available for foreign investors directly as well. But let's not focus on these yet. I would be happy to discuss this in person with you after the webinar if you're interested to see how you can access them. But between CME and BMD, there are lots of opportunities, either outright or in spreads, and more on that later. The good thing is that both exchanges work closely together, so likely your futures broker can work out a structure where you don't need to pay the initial margin calls for both exchanges, but might have some offsetting systems in place to protect your cash capital. Now, let's first start with a large global overview to understand what we are actually talking about. What are the edible oils markets? Where are they? What do they do? What are the global trade flows? Are they worth participating in? The map shown here is from Rabobank and made in 2016. It nicely shows the global interaction and trade flows for all grains, oilseeds and oils. Generally, one can say food moves from the southern hemisphere to the northern one and from the west to the east for grains, while from the east to the west for edible oils. The numbers are outdated of course, but will be touched upon in this seminar with the latest. Don't worry. Let's start with the first question first. What are the edible oil markets and how do they work together? Main edible oil markets can roughly be described into 5 different products with their derivatives: palm oil, soybean oil, sunflower oil, rapeseed, and lauric oils that are palm kernel and coconut oil. All combined, we are talking about a global production of these groups of around 210 million tons, of which 50% is produced here in Asia. That is mainly palm oil in Malaysia and Indonesia and crushed soybeans in China, while the rest is nicely spread around the world. There is an additional 20 million tons of other, smaller oils produced annually and globally. The notional value of the core veg oil market is around 160 billion US dollars per year at an average price of $750 per metric ton. 41% of this volume, or around 86 million tons, are being exported around the world, almost 57.5% coming from Malaysia and Indonesia alone, and the rest is consumed locally in the countries of origin, with India, China and the European Union being the top 3 importers. Palm oil, the most globally traded oil and present in almost every product you buy in a supermarket, is also the most active edible oil in terms of export flows around the world. It has a global production of around 78.2 million tons this year, and Indonesia is the top producer at around 46.5 million tons, followed by Malaysia at 19.5 to 19.8 million tons in 2020. Together, they are good for more than 84% of global production. Other major producers, with an additional 12 million tons or so, are Thailand and Colombia. Due to this concentration of production, the market comes with a relatively large exported global trade flow, as demand in the producing countries is not big enough domestically. The export total is around 53 million tons, coming mainly from Malaysia and Indonesia with 92% market share in the export markets. Kindly note, my numbers are quite a bit higher than the USDA ones in this table, mainly coming due to the higher production in Indonesia numbers, in my view and personal experience. The main consuming countries for palm oil are Indonesia with its huge domestic demand, coming in on the first place with almost 15.8 million tons due to its biodiesel mandates of B30 that grew almost 24% from last year. Note again, my number is higher than the USDA one at 15.15 million tons. In second place of demand, India with almost 9 million tons, third China at 7 million tons, followed by the European Union at 6.8 million tons respectively. The total global domestic consumption adds up to around 77.5 million tons this year, or up around 3 to 4% from last year, even with the COVID-19 situation. Interesting to note is that the stocks to usage ratio dropped from 14.7% for the 2019-2020 season down to a very tight 12.45%, or basically 1.5 months of normal consumption this season, resulting in higher prices and a generally friendly/bullish sentiment in the market. Now, after these core palm basic statistics, let's move on to the next oil on the list, soybean oil, the second largest one. Soybean oil is realistically more of a local play, as it is mainly shipped in the form of soybeans to China and Europe, where it is crushed for both its oil content and its protein content as soybean meal. The 2020 global production, as per the USDA, is expected at around 60 to 60.5 million tons, and this is crushed out of around 362 million tons of soybeans, so the oil extraction rate is around 16.7%. But with a direct global trade flow shipped in the form of oil of only around 12 million tons per year. This is coming from Argentina with 5.6 million tons in 2020, exported out of a local production of 8.2 million tons, and Brazil, exporting 1.2 million tons out of a local production of 8.8 million tons, and a little bit from the US. It is mainly, as mentioned, locally crushed in China, who will import almost 100 million tons of soybeans this year, resulting in 17.8 million tons of oil, and the US with an additional 11.5 million tons in 2020. Other large soybean crushing countries are India at 1.8 million tons of oil equivalent, besides their imports of 3.5 million tons of bean oil coming mainly from Argentina, and Europe, that crushes the equivalent of 3 million tons of soybean oil. Combined between crush and imports, the main consumers are China at 18.7 million tons, the US 10.5 million tons, again a lot of this is for biodiesel, Brazil at 7.5 million tons, also mainly for biodiesel, and India for 5.1 million tons only for food. With such large volumes and the active exchanges around it, both CME and Dalian, they are the most liquid markets to trade with opportunities to trade spreads. Oil share, this is the percentage value of the oil compared to the value of the meal based on the price of the beans, or crush margins, the value of the oil plus the value of the meal compared to the cost of the soybeans, and options around it, are things that you could consider to trade. Next up, the third oil in the complex of vegetable or edible oils, rapeseed oil. Rapeseed oil is discussed under the various names: mustard oil in India, canola oil in Canada, and rapeseed oil in Europe and China, depending on where it comes from and whom you talk to. It is more focused on the oil content, as it has an oil share of around 40% from the seeds, more than double that of soybeans. It is used a lot in biodiesel around the world, and rapeseed oil is produced to the tune of around 27.5 million tons, but it's hardly exported in the form of oil, at 5.5 million tons only, so it's not really worth it to trade as a retail investor, with 65% of this 5.5 million tons coming from Canada alone. The last main oil, before we go to the more chemically complex laurics, is sunflower oil, a high quality food product, well perceived and consumed around the world. Sunflower oil is coming mainly from the Black Sea, meaning Russia and the Ukraine, and Argentina, plus some local production in countries like France. Global production stands at 19.3 million tons this year, with 10.8 million tons, down from 13.1 million tons last year, being exported to mainly India that buys around 2.5 million tons. It has an oil share of around 38.5%, so is similar to the one on rapeseed. As a trader, you can access these markets via CME or S&P Global, but they are not liquid enough in my opinion to actively trade. The final group of vegetable oils are the lauric oils, named after the C12 content or lauric acid in their chemical composition. These are combined as a group and consist of mainly palm kernel oil and coconut oil, who are really the specialty fats used in shampoos and ice creams due to its foaming effect. They are not yet listed anywhere and thus not realistically accessible for retail investors like you to trade. But for the sake of completion, lauric oils are produced to the tune of around 13.5 million tons this year in again mainly Malaysia, Indonesia and the Philippines. Only 5.4 million tons of this is being exported as PKO or CNO, while the rest is locally consumed or processed into oleochemicals. Recapping all the previous information discussed so far here today, let's reflect on the basics. Basically, the only two markets worth trading as a retail investor in my opinion are the palm oil market, with as option access mainly here in Malaysia on Bursa Malaysia for the crude palm oil futures, but also their options and in much lesser format the olein futures. Alternatively, and just as interesting, are the CME crude palm oil swaps and calendar spreads in US dollars. Besides this, of course, there is the global soybean oil and soybean complex via the CME group to trade. For the rest of tonight's session, I will focus on these two markets only and try to come to some conclusions that gives you trade or investment opportunities for the months to come. If you are interested in other markets, for example, as an M&A investor, producer or consumer, we can always discuss this offline out of my consultancy company, PRETB Private Limited. Now, let's move on to the first detailed market under review and likely the one that you are most experienced with already, the palm oil market. The global benchmark is right there with you in Kuala Lumpur, on Bursa Malaysia. But other markets that are active are on the Dalian Commodity Exchange and the Singapore Asia Pacific Exchange. Also, the physical cash markets for olein in Port Klang and Pasir Gudang, and the crude palm oil markets in Belawan and Dumai in Indonesia. Destination markets that are active are the crude palm oil markets in Kandla, India, and Rotterdam in the Netherlands. Key drivers that determine the prices here are the monthly export and production data provided by MPOB, that is the Malaysian Palm Oil Board, coming out every 10th of the month. Just quickly, The ones reported 2 weeks ago were a monthly production for October of 1.72 million tons, export at 1.67 million tons, and a carry-out stocks at a very tight and thus bullish 1.57 million tons. The Malaysian Palm Oil Association, or MPOA, also reports data, but only in percentages per state and at the end of the month. They called October production down 8.12% from September. Some of the regular short-term production numbers are coming out from SPOMA, although that is only South Peninsular Malaysia that is being watched, that were down 11.88% in production for the first 10 days of this month versus the first 10 days of October. Besides fundamental data on the short term, and interestingly, only from Malaysia, as Indonesia does not yet have good real-time statistics, there are also a range of other price drivers. And one of the main ones, and very crucial for us as agricultural traders to keep a constant eye on, is the weather. We are currently all focusing on the La Niña event taking place, and that is causing record levels of named storms and hurricanes and typhoons around the world. As La Niña, meaning little girl, is a weather effect that reduces temperatures, it looks good in terms of global warming. But it's actually something slightly different. The last one that we had was in 2016-2017 was mild, so it had limited effect. But what we are facing today is more to the tune of the 2010-2012 one, moderate to strong, that caused significant havoc to global crops like forest fires in Brazil and more rains here in the region. Nice to notice though for us, in Southeast Asia, I don't expect any large haze periods this year and hopefully even not next year. Just as a counter reference, we just came out of a 2-year long, from 2018 till earlier this year, weak El Niño that increased dryness in the northern hemisphere and temperatures were increased. It caused massive forest fires like we saw in both Australia and the US on the news. A moderate to strong La Niña weather event has developed in the Pacific Ocean, according to the World Meteorological Organization, WMO, early November, and that has only increased ever since, so we should assume that it will tend to be strong. To explain this a bit more, a La Niña develops when strong winds blow the warm surface water of the Pacific away from South America and towards Indonesia. In their place, colder waters from deep in the ocean come up to the surface and cool the air down, changing global wind directions and generally cool the air. This does not take away that 2020 will likely hit the record books yet again as the hottest year in recorded history. This event leads to significant weather changes in different parts of the world. Normally, La Niña means countries like Indonesia and Australia can get much more rain than usual, and a more active monsoon occurs in Southeast Asia. There are likely to be more storms in Canada and the northern US, often leading to snowy conditions. The southern US can be hit by drought at the same time. If a really strong La Niña happens to occur, research suggests that the UK and Europe might experience a very wet winter. South America, on the other hand, will suffer from lower than normal rainfall. The last time that a strong La Niña event developed was in 2010-2012, where South American soybean production suffered strongly from dry weather, and that shrunk global production of the crop in 2011-2012 to about 240.8 million tons, down from 246.7 million tons in 2010-11 and 261 million tons in 2009-2010. The last other points to focus on when trading palm oil are currencies, as they might impact what the consuming countries can actually pay. Think the US dollar, Indian rupee, euro and Chinese yuan, all in comparison with for example, the ringgit. Politics, as they're immediately changing prices when mainly change in import or export duties are implemented. But also, definitely for issues like the European ban for palm oil or the temporary ban from India for only Malaysian palm oil earlier this year. And last but not least, very important to the changes in prices and demand are the moves of complementary or synergetic products. The main ones for this is the bean oil palm oil spread and palm oil gas oil. Their prices immediately impact demand. As a recent example, the bean oil palm oil, or BOPO spread, price decreased from $61 per ton at the beginning of the month of October to $29 per ton at the end of the month. The monthly movement of negative $32 caused a shift in demand away from palm oil into bean oil. The other one, the POGO spread, palm oil gas oil, I will describe in the next frame in a minute. In the bean oil palm oil case, as an alternative to palm oil outright, soybean oil as a proxy of soybeans is leading the movement. To explain this, soybean oil on its own is thus affected by the fundamentals of soybeans, who are led by corn and wheat in the protein markets. So keeping a close eye on all of these markets, and potentially even sugar for ethanol as replacement for corn, is crucial. All these markets and spreads give good opportunities when well managed, so make sure you have a proper risk management system in place and do ask your relationship manager for their views on a regular basis. The other highly correlated market is crude petroleum oil, WTI and NYMEX, that are strongly influencing as well, for the world's biodiesel demand depends on it. They are harder to justify to trade for retail investors due to the high volatility, except perhaps in direct palm oil gas oil spreads, as we can see in these charts. They show that the spread has been positive since October 2019, reducing the need to use palm oil completely if it was not for the subsidies and mandates. As an individual user, I would not consider to use such an expensive oil and food product for energy use at all if it wasn't forced on me, but that's another story. A chart and spread like this could be traded today, for example, with an option structure, where you go long calls on WTI and long puts on crude palm oil in US dollar to capture the expected normalization of the spread for example, the summer of 2021 period, July. Let's now move to the soybean oil markets and what the current drivers there are. They are often the same as already mentioned in the palm oil review, with the exception of the fact that they have more opportunities to trade or hedge. Historically, they generally move in tandem with the palm oil markets, but are around $80 to $100 a ton more expensive. Bigger spreads are hard to justify, as demand can easily switch from palm to soy and back in price-sensitive markets like India, Bangladesh, Pakistan, or even China. Today, the spreads are actually very small on a destination basis. Personally, I like the BOPO spread to own the bean oil, and perhaps hedge this with a reverse spread in the Indian markets on NCDX, where I would short the soybean oil as locally it is heavily overvalued. That would result in both a product spread and a location spread, bean oil palm oil, and international values versus Indian domestic values. Soybean products have much more opportunities to trade than palm oil. They can trade spreads, oil share, oil crush, and might have a much more liquid options market that trades actively in Asian hours as well. For those of you who worry about liquidity in our daytime, as these charts show, the CME Group is providing very liquid tools to trade in the global markets, even here in the Asian time zone outright, or in correlation or as a hedge against BMD and DC. Besides the futures, also the options can be traded either directly via CME Direct or with your preferred OTC risk management providers in our time zone. They are happy to make you a market, but liquidity is slightly less present during our workdays. Every 10th of the month, or around there, the USDA reports the global data on the grains and oilseeds markets, and a few days ago this showed a generally bullish picture that will continue to support values. The US soybean outlook for 2021 is for lower production and lower ending stocks. Soybean production is forecasted at 14.17 billion bushels, down 21 million bushels on lower yields. With reduced production, soybean ending stocks are projected at 190 million bushels, down 100 million from last month. If realized, the soybean ending stocks would be at the lowest level in the past 7 years, and we've actually seen a flow of soybeans moving from the US into Brazil to be re-exported into China. The US season average soybean price for 2021 is forecasted now at $10.40 per bushel, up 60 cents. The soybean meal price is forecasted at $355 per short ton, up $20. The soybean oil price is forecasted at 34.5 cents per pound, up 2 cents from last month, all showing the tight situation. The 2021 non-US oilseed supply and demand forecasts include lower production and crush, resulting in lower exports of oilseed meals and vegetable oils. Foreign oilseed production is lowered 5.6 million tons to 473.3 million tons, mainly on lower soybean crops for Argentina and India, and lower sunflower seed production for the Ukraine and Russia. So how much lower, you might ask? As an example, in the latest report, the corn yields were reduced on dry weather conditions during the harvest season for mainly grains in the Ukraine and Russia by a stunning 8 million tons. But when considering yields, one should keep an eye on short-term, weather-related changes as the USDA is forecasting and that show up on the news, and the longer-term trend yields. I love a chart like this that shows just how effective crop enhancements can be around the world. Yields are up 36.6% since the early 2000s, and this is with a lot of land still under non-GM crops or with ineffective production methods. A country like India that is expected to harvest 12.25 million tons this year on an acreage of 11.6 million hectares, has a yield of 31% of the world average only. Just imagine, even if they can improve their yield to the 2020 global average, they could already produce almost 29 million tons of beans with an oil production of almost 5 million tons, let alone get to the world average in the future. India could become import flow neutral, or at least for the soft oils in my opinion, with proper production enhancements. The US soybean outlook for 2020-21 is for lower production and ending stocks. Soybean production is forecasted at 4.17 billion bushels, down 98 million on lower yields. Some other key points to note that are reflected in the monthly USDA adjustments are the fact that China imported a lot of beans to help in restocking the country and to sort of pay for the US deficit back under the trade agreement during this calendar year 2020. This is resulting that they're now expected to import less in the next year, about 5%, for the crop year 2020-2021 that has started on the 1st of October. Weather, as mentioned, is not good, with dryness in South America continuing and cold spells in the US. The weather forecast shows continued dryness in Argentina, Uruguay and far southern Brazil, maintaining stress on corn and soybeans for the coming weeks and all the way into the southern hemisphere summer. It is expected to show below normal DEC-Feb rainfall across most of Argentina, which could stress corn and soybeans again. Dryness is also expected in northeastern Brazil, but should return to generally favorable conditions for most of the major crop areas in the southern part later on. This next to last chart of the evening makes the circle complete from the original Rabobank chart I showed earlier on, and shows clearly the dominance of only a few players in the soybean complex. China is the major force, importing 100 million tons out of a total 167 million tons of world trade. They consume 32% of the world soybean crop and will continue to dominate the price discovery curve, even if almost the whole world watched what the CME prices do for their guidance. Being able to trade both the Asian session, perhaps against DC, and the global session gives us, you and me, a huge advantage over the companies that are asleep when the consumer world is active. Brazil is the other large force. Just as an example, even during COVID, with diesel demand down around 9% year to date, the soybean oil inclusion was up to its B15 mandate to 12.93% up year on year, supporting the local veg oil values. This will not change, as for 2021, I expect another 4.5% demand growth to around 5.9 million tons, likely turning Brazil at some point into a net oil importer from Argentina, like they were in the soybeans already this year from the US. Putting the USDA report and the last list of comments together, while showing a great visualization from S&P Global from earlier last week, are the incredible changes in global soybean production over the last decade before we go to the trade IDs. Edible oil demand is picking up over consumer confidence returns. Biodiesel demand, and with significant harvest issues on palm due to the COVID, thus prices are likely to remain strong and supported. Crude oil is gaining strength after the vaccination comments on the 9th of November, and I expect values to trade in the range of $45 to $50 for Brent for the remainder of the year when people are getting in their cars again and global sentiment improves. From an investment point of view, commodities are undervalued versus equities, and with enormous stimulus from the governments around the world expecting inflation to come in, it is bullish for our markets. Most financial analysts see upside ahead, particularly in non-energy commodities like agriculture and metals, citing tightening supply amid adverse weather conditions and greater demand from China. Goldman Sachs expects base metals and agriculture to have more near-time upside than oil, with smaller inventories to move through before prices begin to rise. Given that inventories are drawing this early in the cycle, we see a structural bull market for commodities emerging in 2021 with a potential upside of 20 to 30%, but part of this is already priced in with the recent gains. Still, personally I am friendly commodities and edible oils, in particular over the increased soybean demand, reduced palm stocks and improving crude oil valuations. Using agricultural commodities as a hedge against inflation, returning demand and the US dollar weakness that is expected sounds like an opportunity to me. Keeping this in mind, now let's move to the last part before we have time for the Q&A. And talking about that, for the Q&A, please put in your questions or comments into the chat box now, if not done so yet, so that I can use the right charts for my replies. As you probably expect, at some point I need to start adding more formal trade IDs, besides the ones already discussed during the evening. I will try to split them up in short term, as in the coming weeks, medium term, as in the next 3 months, and longer term trade IDs. Please do note what was discussed in the first part of the webinar. These are only my personal views and are only provided solely for informational purposes and should not be regarded as a recommendation to buy, sell, or otherwise deal in any particular investment. My view can and will change on a continuous basis. To quote the economics Nobel Prize winner Paul Samuelson in 1970, although the same quote is often contributed to John Keynes, "When my information changes, I alter my conclusions. What do you do?" Basically, it says we have to keep an open mind to all data that comes in and not get married to any position. Definitely not when it is costing you money. It looks like we're heading towards one of the strongest annual performances by the grains and oilseeds in the last couple of years. In the first quarter of the year, with the pandemic threatening to derail the global supply chain, I believe that not many would have envisioned such a turnaround since the summer in mainly Asia Pacific. Now we are seeing a lack of rains in the major growing regions for the second half of the year that has played havoc with the global production numbers. Some economies like China bounced back earlier and faster than expectations, and all of these factors resulted in a tight global balance sheet and strong price rallies in the global commodity markets. Threat of adverse weather conditions still haunts South America and the Far East, but more on that in the next visual. This is the latest weather chart from Sunday, and it shows less than ideal rains likely to cause continued crop stress, reducing the yields. Besides the weather, the last 2 weeks were relatively light on trading inputs following the big USDA report price moves and the US election volatility in the week prior. Trading focus is back on fundamentals now. South American weather, US farmer seller, spreads basis relaxing, as well as a recorded long fund position in the Commitment of Traders report. Fundamentally, Argentina got some much needed moisture last weekend, southern Brazil is raising the forecast, and farmer seller has softened basis. Chinese demand remains firm, a strong yuan helps, and thus the grain and oilseed balance sheets remain tight. Politically important, China signed the RCEP agreement on the 15th of November with 15 regional countries. This is the world's largest free trade agreement with almost 2.3 billion people living in it. At the same time, Chinese industrial production data came in better than expected at plus 6.9% year on year, boosting Chinese stock markets and the currency. What the effect will be on the RCEP is not clear, but it is good for global and regional trade, that's for sure. Soybeans, bean oil and cotton show the highest co-movement to the yuan historically. Copper, another China-linked commodity, is at 2-year highs. For us here on the call, it is interesting to note that last Friday the long-awaited formal announcement came out that DC will start to offer the olein futures from the 22nd of December onwards for foreign investors directly. This takes away the need to use a WUFI onshore, and your broker will know more about it. With this release of access, it gives you the opportunity to trade the spreads and relative values between both Bursa, CME and DC now. It is now the 7th contract that is being internationalized by DC and provides super liquid arbitration opportunities. Now, back to the trade opportunities. Flat price. This means should we be long or short soybeans, soybean oil and products? As I recommended in my weekly report over the weekend, for soybeans we continue to hold the longs established earlier this month at around 10.35 for a profit of about $1.7 per bushel. Beans are quite likely to go beyond $12 if current fundamentals persist. Keep a trailing stop loss to retain profits on the longs established and consider replacing some of the futures longs with calls, thus invest part of your profits. Stay long in palm oil over US dollars in the current production issues continue. Own soybean oil basis against biodiesel demand. Own soybean oil options, short-dated calls, and trade the ranges as we will have some days and weeks with hard drops and gains. Trade against these volatile moves and don't be greedy, but stay relatively close to home in general with a long bias. Keep in general a buy at dip strategy in place, but don't be afraid to cash in on profits. Trade the seasonal Christmas rally on edible oils. Basically, historically, if you go long after Diwali and Thanksgiving, so this week, and sell between Christmas and New Year, you have a very high chance to make significant returns, as many plantation companies are using the lull in activity to increase their share price by going or staying long at the end of the year. And for sure this year, with COVID, I think that very little will happen from the 18th of December onwards. So I am long in calls with early expiry on both Boursa and CBOT. Spreads. As mentioned before, soybean oil seems massively overvalued in places like India, where imports were lagging due to COVID. So should domestically come down to more normal spreads, as demand will switch to palm oil and local crush will start seasonally now after Diwali. On the other hand, it is undervalued in the CME direct spreads as shown before in US dollars. An arbitration here is complicated but feasible. Depending on your options, I would trade the spread from the short side on NCDX and the long side on CME. In terms of Pogo, I would stay out till more is clear about the coming back of energy demand. But if you can, buy options to short it. Short palm oil, long gas oil, with expiry into mid-21, as that would for sure be interesting. Going long calls into the summer for WTI and long puts against this on palm oil in US dollars, purely as a spread trade, betting on a more normal market post-COVID. Consider trading the spread on CBOT or with both legs in the separate exchanges, but make sure you trade both of them in US dollars to avoid having to hedge the forex risk on top of it. Often you can do this lagged, meaning in two different markets, having to pay the margin call twice, but some providers will provide you direct quotes on this and even option structures around it. Volatility. Yeah, options. The most money was to be made this year in owning the volatility or even the volatility index, the VIX, either at macro level, but even at individual products. This is still the case, but likely we will see lower vol in the coming weeks going into the year end. I like to own short dated options like the weekly ones and trade a lot of option structures like pivot accumulators with some of the OTC risk management tool providers. With the current vol levels at around 32% for palm oil, though they seem overvalued, so perhaps hold off until we see a bit more stability in it or go short the vol via structures. And with these investor trade or corporate hedge ideas, I would like to close off this seminar from a fundamental data and information point of view. But I am here to answer your questions now. Some of them already were posted in the chat, but feel free to keep them coming in as we still have some time. Again, as previously mentioned, after this event I am contactable via www.pretb.net for all your consultancy needs. In the presentation deck that will be shared or is available for download, I will put some useful links to some of the data resources that I use, as well as to some of the reports that you can subscribe to. Thank you for your attention so far. Please stay on the line, as there will be a few more comments coming straight after the Q&A. So, now, let's see where I can add value in terms of replying to your feedback or questions.